Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Bruce Bond, co-founder and CEO of Innovator Capital Management. Innovator offers about 100 ETFs with 14.5 billion in assets under management. And today we are talking about the world's first ETF that offers 100% downside protection to investors. Bruce, welcome back on the show. So nice.
Neena, thank you so much for having me.
So let's talk about defined outcome ETFs and then this particular ETF. So buffer ETFs or defined outcome ETFs, they allow investors to participate in the market's upside up to a cap while limiting losses if the market falls. And this is one of the fastest growing segments of the ETF market. These buffer ETFs, they saw record inflows last year as well as this year amid continued market turbulence. And Innovator is a pioneer in buffer ETFs. You launched the first defined outcome ETF in 2018. We had you on the show back then. And then last month, you launched this ETF, the new ETF. It is called the Innovator Equity Defined Protection ETF, ticker symbol TJUL. This provides 100% downside protection. So tell us why you decided to launch TJUL and why now?
Well, the reason we launched it was we are finding that more and more people are interested in opportunities to participate in the equity markets, but they want to have a better sense of the outcome of their investments at the end. Most of the investments that in the open market that investors have an opportunity to participate in only give them all the upside, all the downside, and there's some switching and there's some reliance on correlations and things like that investors have to hope will deliver them the outcome that they're hoping for. The defined outcome ETFs, and specifically TJUL as well, it tells you, look, you have no risk on the downside, and you're going to get this amount of upside over the next 2 years, and you don't have to worry about losses. That is the reason we decided to launch it right now. And it has been, very well received because people are interested in protecting their assets.
Yes, this is definitely a very interesting product. And this seeks to track the return of the SPY S&P 500 ETF, SPY, up to a cap of 16.6% while buffering 100% of losses over the outcome period of 2 years. So tell us, how exactly does this ETF work and what does it hold?
Yes, I'd be happy to do that. And I think the important thing for people to understand, if they're interested in this, what we encourage people to do is go to the website. We have some great information on the website that you can read more in depth if you're interested in learning more about the product. And we always recommend people do this. But on face value, the product is very simple. It's TJUL, and JUL is for July. So this product was launched in July. And then in July of 2025, this product will end and reset. It doesn't end, it just resets in 2025. And it will give you another period of 2 years where you can't lose money over the next 2 years, but you get the upside that's available through the market. And it's really a very simple investment. One of the things to pay attention with this particular product is you want to buy near the beginning of the outcome period. And you want to hold it through the end of the 2 years, but you always have the ability to sell it anytime you want, just like all ETFs.
You mentioned the outcome period, which started in July and runs through June of 2024, the 2-year outcome period. So investors who did not buy this product in July, what kind of outcome they can expect now. And there may be investors who would like to sell maybe before the end of the outcome period. So how does the outcome differ for those kind of investors?
That's a great question, and that is what you want to pay attention to. If you go to the Innovator website, you would be able to look today at TJUL. Just type TJUL up in the search box. It will bring it right up for you. And you will see what your return will be over the next, through the end of the outcome period. And then you will also see the amount of risk on the downside. You still won't have any risk on the downside. And because the product, it has traded down a little bit, because when we brought it, the market was kind of high, and now it's come down. Therefore, now you have the opportunity to get more upside. It was 16.6 originally. Now it's up around 17.5% that you have upside through the end of the outcome period. And then it will reset at the end of that outcome period. I think it's important for people to understand there's nothing you need to do with this. You don't have to sell it at the end, I guess, is the point I'm trying to make. You can just simply hold it, and it will reset and will go through another outcome period for you. But you can, if you choose to sell it, you can do that at any time.
I certainly encourage our listeners to visit your website. You have some great educational materials, so learn about what kind of outcome they can expect, and also learn more about this product if you're interested. So we know that there are no free lunches, particularly not in the investing world. What do investors give up in return for this kind of downside protection?
That is so true. There are no free lunches. And what you do give up is, if you look at what the cap was initially when the product was launched, it's 16.67%. You would give up any return above 16.67% over a 2-year period. You can look at that like approximately a little over 8% a year, or however you want to look at it. But you will give it up if the market is up substantially. The beauty of it is that you don't have risk on the downside. So that is what you give up. The fee on the ETF is 79 basis points. And so there is a management fee on it. And so you would just be charged that like any other ETF.
So this holds flex options that you mentioned. Any chances, any risks with these kind of options that investors should be aware of? And you mentioned the expense ratio of 79 basis points. Are there any chances of expenses going up for any reason if the market sees unusual turbulence or something like that?
No, there is no risk of the fee going up. And the good news is ETFs, most ETFs have what's called a unitary fee, which is a total fee. So there are a couple fees outside of that, but they're minor. And so by and large, your fee is 79 basis points, and that is what you should expect. And there's no risk of it changing at all. Now, regarding flex options are like normal options, but they're customized. And what that means is you're allowed to, you can with them, you can give a customized beginning and end of a period for an option, which allows us to be very precise when we are setting up the portfolio. And so it can start on the day we want it to start, and it can end on the day we want it to end. And that's very convenient, when you're doing something in July, on the 1st of July, and you want it to end in 2 years and reset, you can do that very precisely. And that's why we use flex options. Now, these flex options are based on the SPDR. And the SPX options and SPDR options are the most liquid options in the world. And they have, a pool in the billions and billions of dollars every day that are traded, which makes these flex options very liquid and allows the ETF to trade with very tight spreads because the underlying is as liquid as it is.
Now, we know that these kind of downside protection products have been available to investors, maybe in the form of fixed index annuities or market-linked CDs. So could you talk to us about TJUL's advantages, or if there are any disadvantages compared to other protection products? And I was also interested in knowing how big is the market for these kind of protection products.
We think this market is very large, and these products really are designed to bring in the investors that would use a market link CD or use some type of annuity protection, and or typically so that they don't lose their money, to look at these products as an alternative to those products. And we think there are many significant benefits to the ETF over those other products. Some of the benefits can be cost. Now, some of those products, it's difficult for investors to see what the cost of those products are, because a lot of the expenses are embedded within the product. And, if they lower the cap, that's just more fees or more costs that are embedded within the product, and it's hard to see it, but it's there. The beauty of the ETF is it's completely transparent. You can see everything you own it directly. And one of the things about owning the options in the underlying ETF directly, that you own those, you can see them, you can see how they're pricing, you can do all those things. Is that, there isn't credit risk within the ETF. When you buy a market link CD, obviously you have the risk of the bank. If the bank goes down, then you may lose your money. Now, some of those have FDIC insurance on them, but I think we still think a lot of people want to sometimes put more money than that in a market link CD, and we think it's wise to maybe use an ETF where you don't, you own the asset. There's no need to have insurance on it. Secondly, same thing with the insurance company, that you are exposed to the credit risk of that insurance company in an annuity, because they are really making the promise to pay you back. And if for some reason they become insolvent, as we have seen can happen, you may not get paid back your money, and many people aren't comfortable with that. So one of the benefits of the ETF, obviously, is that it doesn't have credit risk. The second one is transparency. You can see what you own, and it's very price efficient. And what that allows for is it allows us to deliver much more cap on the upside for investors than some of the other options that would be available in a market link CD or even in an annuity. And then another one is liquidity. You can sell it at any time, and you also know what the value of it is at any time. Whereas with the others, it's very difficult to determine what the value is. And if some you can sell, but there's big penalties and surrender charges if you do sell them. And so that's another reason that I think the ETF really shines. And I think the last one, and I think one of the most important ones, is taxes. And the beauty of the ETF is that you have the ability to defer your gains into the future. And the ETF will reset for you each year, and your gains will continue to compound into the future, and you will not have to pay tax on those until you decide to sell the ETF. And versus, in a market link CD, that's ordinary income, or if you take it out of a annuity, obviously that's ordinary income when you take that as well. And because of the tax benefit, we think that that's a tremendous benefit for people to be able to grow their assets long term without risk and compound them at a much greater rate than they ordinarily would have the opportunity to do unless they were in some type of a protected account.
Yes, ETF structure is so much better than other competing products. So how does this product fit into an investor's portfolio? We know that a lot of investors have a lot of cash in their portfolios, particularly after last year's market turbulence and market plunge. Many have invested in short-term bonds, etc. So is it supposed to replace cash portion of the portfolio, or short-term bonds, or the equity portion of the portfolio?
Yeah, I think that's a great question. And we really think that for people that, it really depends on individuals' risk tolerance. Some individuals are all about preservation. They don't want to put capital at risk, but they do want exposure to the equity markets. And this is the ideal product for those types of very conservative investors. But as you mentioned, for investors that are in cash right now, they don't know, is this the time to get in or is this the time to be out? And I would encourage them that no one really knows when to get in and when to get out. It's very difficult to know. What this product does, it gives them the ability to get in and to know that they don't have risk of loss, but they do have the potential of the upside of the market. And if they decide they're up a good bit and they've made some money, they can always roll over into the new issue. We're going to be introducing these semi-annually and potentially at some time more often. They could roll over into the new issue and lock in whatever gain they have at that point and then just continue on. Now, they would pay tax if they did that. But, those are the types of options available to investors. But yes, I think very conservative investors and investors that just are not comfortable with equity market risk and do not want to take that risk, or really are at a point in retirement or nearing retirement where they can't afford to take that risk. They can't afford to lose money, but they need to make more money. This is a great product, an ideal product for them to weigh into the market with.
Great. Yes. So do you think this is more suitable mainly for risk-averse investors, as you mentioned, those who are nearing retirement or who are already in retirement? What about the younger investors? Because we know that over the longer term, stocks tend to go up. So if you are a young investor, if you have a longer term focus, then probably you should just ignore short term noise, because if we see since its inception in January of 1993, SPY ETF has returned a little over 10% annualized. So by seeking downside protection, investors do forego some upside potential and the dividends too. So do you suggest that this product should be used mainly by investors who have low risk tolerance?
Yes, I would recommend that younger investors that have a longer investment horizon, that they go ahead and take more risk on in their portfolio so that they have a longer term to take on some of the volatility that's in the market, but more potential for upside. I think this is more ideal for people that are very risk averse and do not want to take risk in the marketplace, and or have a lot of cash on the sidelines that maybe they have to use at some particular point, and so they can go ahead and invest that and then hold on to TJUL for a while until they're ready to make the purchase or whatever they need the money for. So it's good for planning for that way as well.
Great. So since we have you on the show, I was also interested in talking about the ETF industry in general, because you are one of the pioneers of the ETF industry. And for our listeners who do not know, you co-founded PowerShares in 2003, which was then sold to Invesco in 2006. And PowerShares was behind so many very interesting, very innovative ETFs, many thematic ETFs, many smart beta ETFs. So I was interested in your thoughts on the direction of the ETF industry. Where do you see the future of the ETF industry heading? Are there any concerns, or what are you most excited about?
Yeah, I'm very excited for it. I mean, I think that we're going to continue to see the migration of active ETFs or mutual funds into the ETF space. I just think that the ETF structure is superior to the other structures and delivers more of the return to investors. And I think that's really the key thing. You want to use the structure that delivers the most of the investment return to an investor. And I think today an ETF is what does that. And I think that excitingly enough, I think Innovator is kind of on the forefront of introducing what I think is going to be a big growth area for ETFs over the next 5 to 10 years minimum, as people start to understand that they don't have to take on the full risk of the equity market or of the bond market. I mean, think over the last couple of years, both the equity market and the bond market really damaged people's portfolios. And the correlation that the industry has been talking about between the negative correlation, typically between stocks and bonds that they've been talking about for so long, was non-existent, and people lost a lot of money. And we think that with defined outcome ETFs and some of these other ETFs that we're looking to introduce, that people will be able to know the amount of risk they're taking, and they will have the knowledge of knowing what their outcome will be based on what their underlying reference asset does, meaning like the SPY or the Qs and things like that. And so we think that those types of products are going to be very attractive to people in the future. And they just haven't been available to retail investors in the past. And we think that putting them in an ETF, making them readily accessible, easy to understand, is going to really cause a big growth spurt within the ETF marketplace and products that will be available in the ETF form.
Excellent stuff. Bruce, thank you so much for joining us today and for sharing your insights. And also congratulations on the successful launch.
Thank you very much. It was great to be here. It's good to talk to you again.
That was Bruce Bond of Innovator Capital. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.